afternoon, everyone. Hello and good afternoon, everyone. Welcome to the State of the Industry webinar. We'll be starting in just a few minutes, and as we're still waiting for a few joiners to come in, so we'll be putting on mute for now, and we'll be starting in just a couple of minutes. Thank you.
Good afternoon, everyone. To those who are connecting from London, and welcome to everybody from all over the world that are joining the webinar on the 2018 State of the Industry Report on Mobile Money, our annual flagship publication. Every year we hold this session to offer the opportunity to engage with the audience around the key findings stemming from our research. My name is Ruan Swanepoel. I'm the head of the GSMA Mobile Money Program, and with me I have Francesco Pasti, the senior manager and author of this report. And we'd also like to thank the support that we get from the Bill and Melinda Gates Foundation, the MasterCard Foundation, and Flourish. For those who are not familiar, Flourish is a new entity that was established by Omidia Networks, focused on the financial inclusion initiatives, and will continue to do the great work that Omidia has been doing in supporting entrepreneurs whose innovation helps people achieve financial health and prosperity. I'm really pleased to see the interest in today's webinar. This will make for a very interesting session. We'll start with a presentation by Francesco, which will last around 30 to 45 minutes, and then we'll follow that by a Q&A. Please feel free to send through any questions as we go along, and we'll try and answer those towards the end of the presentation. Before I hand over to Francesco, I'd like to just say a few words to frame the discussion today. Our role as the GSMA is to work with mobile operators and relevant stakeholders to provide safe, secure, and affordable financial services through mobile technology. We produce research, build industry assets, and advocate for enabling mobile money landscape. In this context, the State of the Industry report builds on a supply-side data provided by mobile money providers across the globe, which we study and produce the analysis of the key industry trends, as well as identify challenges and opportunities for mobile money providers. We know that over the last decade, mobile money has been transforming access to financial services around the world. The report shows that the scale of mobile money continues to grow, with more than 866 million registered accounts in 90 countries, doing a staggering $1.3 billion a day that's transacted through this ecosystem. The industry is now fast evolving against a backdrop of increasing internet access and smartphone adoption. Successful providers are moving towards a payments as a platform approach, and as we see this expanding value proposition to a full range of third-party products and services that will continue to suit customers' diverse needs. The benefits of mobile money continue to be a real and far-reaching for a wide range of users, including the world's most vulnerable, especially displaced persons and women. 55% of those providers that we surveyed indicated that they have partnered with humanitarian organizations, and this is an initiative that we closely supported by the GSMA Mobile for Humanitarian Innovation Program. In August 2018, our Connected Women team released a gender analysis and identification toolkit. In short, we call it GATE, which is a machine learning algorithm that analyzes mobile usage patterns to assist operators in reaching underserved female customers with relevant and tailored products and services. Now more than ever, mobile money's unparalleled scale provides a tremendous opportunity to reach the 1.7 billion people who remain financially excluded. So we see today that there's a huge opportunity still out there for the mobile money providers to go and really make a difference. So I'm going to hand over to Francesco now, and he'll look at some of the trends that we've seen over the last year.
Great. Thank you, Ruan. So if we start, we saw that 2018 was another strong year for mobile money. The industry added another 143 million registered customers, which was another record in terms of absolute numbers, reaching 866 million registered accounts. This was a 20% year-on-year increase. And as in 2017, most of this growth came from Asia, where 90 million new accounts were open. If we look at the number of accounts, we see that there are 866 million registered and approximately 300 million active accounts. So this is basically around 34.5%, just slightly up from 33.9% the previous year. And activity rates are once again highest in Latin America at almost 50%, so 48.5% to be exact. And we've seen the biggest increase year on year in Asia. So where activity rates in several countries have increased by more than 10 percentage points. And while activity rates in sub-Saharan Africa remain stable compared to the previous year at about 37%, the region has added over 17 million new active accounts in 2018. And in 13 African countries, over a third of adults are active mobile money users. So it kind of highlights how a number of big operators have been able to really push activity levels closer to kind of the figures and the ratios that we see for retail banks in Western Europe or in emerging countries. the industry, as Ruan said, is now processing over 1.3 billion US dollars per day, and digital transactions are growing at more than twice the rate of cash in and cash out. So in December 2018, the industry processed 40.8 billion. This is the 1.3 billion daily figure. And as I mentioned, cash in and cash out still represent the majority of mobile money flows, but digital transactions, which we categorize as P2P, airtime top-ups, bulk payments, bill payments, merchant payments, and international remittances, have been growing at twice the rate, and this was driven largely by bill payments and bulk disbursements. And if we translate this 40.8 billion on a monthly base, what this means is that the average active mobile money customer is doing approximately 12 transactions a month, worth $206 approximately. And also what we're seeing is that whilst the growth in sub-Saharan Africa is slowing, this is mainly because of the maturity of Eastern Africa, other African regions are growing steadily. In particular, West Africa has continued its strong growth path, and if we look at Ghana, Benin, Senegal, and Cote d'Ivoire, over 50% of the adult population is using mobile money. And the growth in geographical diversification of mobile money is also clear when we look at the deployments that have over 1 million active customers. So these were only 13 5 years ago, and as of December 2013, and they're now 64. As I mentioned, for the second year in a row, Asia was the fastest growing region. Asia grew at about 30% in terms of registered customers, and this is compared to 14% in sub-Saharan Africa, so kind of double the rate. And also, it's interesting when we look at activity rates, which in Asia also grew much faster. It grew at 40%. And what does this translate is that East Asian Pacific now accounts for 11% of registered accounts at a global level. And sub-Saharan Africa is now at 45.6. And to put it into context, if we look at basically the same graph or the same figures for sub-Saharan Africa, at the end of 2015, sub-Saharan Africa was accounting for close to 55% of all registered accounts. So while providers in sub-Saharan Africa are still driving growth in registered accounts, rates are naturally slowing as the market is kind of plateauing, and the majority of the population is gaining access to mobile money. However, there is still a very strong opportunity to unlock growth and increase financial inclusion in the continents, what we define as the sleeping giants, so Nigeria, Ethiopia, and Egypt. These are Africa's 3 most populated countries, which are home to a combined adult population of over 242 million people. And in 2018, regulatory reforms were introduced in Nigeria and Egypt, and also a kind of a new financial inclusive strategy in Ethiopia have been attracting the attention of both MNO and non-MNO led players. And despite the many challenges to overcome, we anticipate that these reforms could really push a new wave of adoption in these 3 countries. And we estimate that this could lead to over 110 million new mobile money accounts open in the next 5 years. In this year's State of the Industry, we also looked at the role that mobile money plays in terms of enhancing financial inclusion in emerging markets. And so if we look at this slide, it's quite complex, but basically the analysis on this slide leverages the Findex data, and every dot that you'll see is representing a country. On the x-axis, we look at Findex data and the percentage point growth of adult population owning an account at the financial institution. So basically, it will compare 2014 to 2017 data. And for instance, if you look at the dot on the far right, that's a country that has experienced over 40 percentage points growth in its population owning an account. And what we see is that 31 markets saw an impressive increase of more than 5 percentage points in account ownership at a financial institution between 2014 and 2017. On the y-axis, we look at the growth, always in percentage points, in active mobile money account as a proportion of adult population in a country. So if we take the country represented by the black dot on the far left, which I just highlighted in red, the country experienced a growth of 8 percentage points of its adult population having an account in the same country, and in the same country, the proportion of active mobile money customers on adult population, which we see also grew at 8%. And in these countries in black, which are above the trend line, mobile money has been the main driver of financial inclusion. And what is also interesting is that of these 31 countries, a third of these were in either Asia or Latin America, showing that the impact of mobile money on financial inclusion has extended beyond sub-Saharan Africa. And countries where mobile money contribution to the general growth of financial account is not significant tend to have a lower than average regulatory index score, which highlights the importance of establishing a more level regulatory playing field that can allow for innovative market solutions to increase financial inclusion. Also, when looking at financial inclusion, reducing the gender gap remains a priority. And there is evidence that the mobile money gender gap is narrowing. So according to the 2017 Global Findex, between 2014 and 2017, the gender gap closed in 17 countries in sub-Saharan Africa and also in one in LATAM, which is Bolivia. And if we combine our data, we see that from our 2018 adoption survey, data show that providers are leveraging their distribution network to reduce the gender gap, with female agents emerging as a very powerful asset for reaching female customers. So whilst there is a number of components that will influence this, we saw that for those respondents that were providing data on both the percentage of their female agent base and their female customer base, there was a very strong positive correlation between these two variables. So while the industry is maturing, 2018 saw a vast array of events, making it a very interesting year for mobile money. We saw investment for tech giants in Southeast Asia, a very large African operator that spin off its kind of fintech operation and listed for a value of over 3.5 billion at the end of 2018. And also during the year, we saw some very important regulatory reforms in Nigeria that I mentioned earlier, as well as strategic partnerships and regional interoperability with the launch of the Mowali initiative from Orange and MTN. And these events can mainly be grouped under four main trends and that we see impacting the industry, and it shows how the industry will evolve in the following years. So the first one that we look at is an enhanced customer experience that we see being driven by the growth of use cases, mostly brought by smartphone and interoperability. We also see diversification in the financial services ecosystem, especially in Asia, with a large number of players entering the payments area. Also an increasing complex regulation. And as the fourth trend, we see the expansion of the mobile money value proposition, with operators looking to expand from a fee-based model, on a fee model based on cash outs, to a platform approach that Ruan mentioned earlier, which connects users to small businesses and opens opportunity for new innovative products and services. But let's look at these trends one by one. So if we start with the first trend, we see that the agent distribution network, which has been always a very strong, vital component to the growth of mobile money industry over the last decade, continues growing. In 2018, the number of registered mobile money agents grew 18% to reach 6.6 million. 57% of these agents are active on a monthly basis. And whilst cash-in and cash-out transactions still represent the majority of the flows in mobile money, and grew 11% year-on-year in 2018, digital transaction values grew more than twice as fast at 24%. So if you look at the figure, you'll see that of incoming transactions, so basically how money is entering the mobile money ecosystem, 73.2% is cash-in. Now, this is still a very high figure, but just a couple of years ago, this was close to 90%. And we're also seeing that kind of best practice players have been able to reduce this proportion to just over 50%, so an increased digitization. And also, if we look at the outgoing transaction, 67% or $68 out of 100 that are exiting the ecosystem are exiting in cash. However, again, this figure was much higher just a couple of years ago. And the main drivers of digital growth in 2018 were bulk disbursements, which grew at approximately 30%, and bill payments, which grew at 41%, which is also a signal that the mobile money providers are becoming strong partners for enterprises. But the two drivers that were pushing the growth of digital transactions were mostly interoperability and smartphones. So if we start by interoperability, we see that interoperability continues to be a strategic priority for the industry, not only to increase the utility of mobile money for users, but also enables increasingly important use cases such as bulk disbursements and bill payments to scale up faster. Overall, off-net P2P transactions, so going from one operator to another, these volumes more than doubled from 2017 to 18, and in interoperable markets, we saw that this growth has not led to a decline in P2P transactions. However, interoperability needs to be looked in a broader way than just P2P. So mobile money to bank account interoperability has continued growing significantly and increased by 47% year-on-year in 2018. And we see that on average, mobile money providers with bank integrations are connected to 10 banks, which has increased dramatically volumes moving between mobile money and banking system. And also interestingly, whereas a few years ago, flows were mostly into the mobile money ecosystem were outweighing those going out. Today, this is much more balanced, and it shows that banks are now also leveraging and providing solution to micro, small, medium enterprises to pay for suppliers. If we look at smartphones, we see that smartphone adoption is also increasing dramatically in emerging markets, especially where mobile operators are investing in connectivity and vendors are pushing affordable devices to the market. However, again, if we look at the story between, or the differences between Africa and Asia, we see two kind of different pictures. So in Africa, 90% of mobile money transactions, or actually over 90%, are still driven by USSD. And the picture, on the other hand, in Asia and LATAM is very different. So in Asia, LATAM, and also in some Middle Eastern countries, 1 in 3 mobile money providers that offers a smartphone app are seeing 20% or more of their active customer base transacting through the app. And also a growing number of deployments in these regions are seeing over half of all transactions being performed through smartphones app. And there seem that there are a few questions probably on this topic that we'll be covering just shortly in the Q&A. So if we look at the second trend, this is around the diversification of the financial services ecosystem. So again, here there's a different picture between sub-Saharan Africa and Asia. And we know that large MNO groups still dominate Africa's mobile money ecosystem, providing an increased range of innovative digital solutions to urban and tech-savvy customers. But in Asia, the competitive landscape has changed substantially over the past couple of years. So in addition to mobile money providers, the Asian market also hosts a number of fintechs such as Alipay, tech giants as Tencent, which are quickly expanding. But in recent years, the share of the combined adult population in Asia with a mobile money account has also increased very rapidly. So South Asia has seen the fastest growth in the region, with a CAGR of 63% between 2013 and 18. Which today means that more than a fifth of the population has what we define a mobile money account. Meanwhile, in Southeast Asia, account registration also has grown quickly. Between these 5 years, 2013 and 18, it was a compounded annual growth rate of 44%, resulting in a similar population penetration rate of close to 20%. However, while the growth in registered accounts in Asia is remarkable, the rates of account ownership and usage are still low in many countries, providing a real opportunity for MNOs and other financial services providers. So while mobile money providers in Asia are connected to more online merchants than average, we see that deployments have fewer integration with companies leveraging mobile money for bill payments and bulk disbursements. So on average, Asia mobile money provider are connected to 33 billers, and this is less than a third of the global average at 102. And also the difference in bulk payments and companies that can provide bulk payments is even greater. So an Asia operator will be connected to 69 companies versus an average of 237. And so we see this presenting a significant and largely untapped opportunity for providers in the region. Also, the disparity in these two services is noteworthy, as these services have been the main drivers behind digitization in other markets in Africa. And in the next slide, we see how 2018 saw a number of non-financial players diversify and invest in mobile-based payment businesses in order to gain market access in the payment space and then leverage their experience to strengthen portfolio companies. And this underscores the commercial potential of mobile money. Of course, this also will be driving social benefits, but it's also a sign of growing competition. So for the slide here, for instance, if we look at Facebook, we can see that their business model started as a social platform, expanding then a commercial platform, and we see now that there's an increasing focus on payments. Mobile money operators have started as telecom, going then into payment services, and are now, and some of them are now looking to also expand in other commercial platforms. So in this case, we're showing the example of Masoko, which is a venture started by Safaricom in Kenya. The third trend looks at the increasing complex regulation in the market. So we know that enabling regulation has a tangible influence on the adoption and usage of mobile money services, with the most successful providers today operating in markets that we define as enabling. And on the other hand, we saw that restrictive regulatory frameworks can stifle investment and limit the uptake of activity. And we see that 5 main regulatory trends have emerged in regions with mobile money services in 2018. So we see taxation being one of them. And in 2018, concerns about taxation intensified regarding the introductions of taxes on mobile money transactions through mostly the African region, affecting markets such as Uganda, Zimbabwe, Kenya, and Gabon. And specifically, if we look at the case of Uganda, we saw that the value of P2P transactions declined by 50% within 2 months of implementation of tax. With around 100,000 agents, saw their earning decline by 35 to 40%, and approximately 30,000 agents going out of business completely. We also saw the kind of know your customer requirements and the ability to, we see how the ability to conduct KYC efficiently and effectively is a key to expanding access to mobile money. However, we saw that the capacity of the industry to scale is being challenged by increasingly onerous requirements. And to address these challenges, providers are taking 2 approaches. The first is on simplifying customer onboarding, where we see examples from Sri Lanka, but also Pakistan and Ghana, which basically are allowing the use of SIM registration data for mobile money KYC. And the second trend is around the use of digital IDs to enable electronic KYC. The third trend that we look at is focus on kind of cross-border remittances. And we know that today the average cost of sending $200 via mobile money is 1.7%, which is a reduction of nearly 40% since 2016. And the mobile money industry has been recognized as a very strong role in terms of lowering the cost of sending and receiving remittances. And there has been a greater push for interregional operating models that can ensure that more people can benefit from these cost savings. But however, in many markets, regulation remains a key barrier for further expansion. And the last trend within the kind of increasingly complex regulatory framework is around data. So mobile money need to consider many recent changes in data protection regulation that may have an impact on the provision of mobile money services, in particular relating to data security, but also localization and data processing and sharing. So, for example, some data localization requirements stipulate that customers' personal data collected within a particular jurisdiction must be stored or processed within the same jurisdiction boundaries, which will result in prohibitive costs for providers and will actively disincentivize market entry and compromise further innovation. So this kind of fast-evolving regulatory landscape calls for a more nuanced evolution of the regulatory framework, which extends beyond the binary categorization that we used to have in terms of enabling or non-enabling countries. So in 2018, the mobile money team of the GSMA assessed regulatory frameworks in more than 80 countries and developed the Mobile Money Regulatory Index, which assesses the effectiveness of regulatory frameworks. And the index provides regulators and other stakeholders with insight into improving the regulatory environment, which will ultimately will push to kind of expanding mobile money services. And this is based on 6 dimensions and 27 indicators, which were weighted by impact. So in terms of the 6 dimension, in the case of these are comprised by authorization, consumer protection, transaction limits, KYC, agent network, and also infrastructure and investment environment. And so here we look at the case of Pakistan, that out of 100 has a regulatory index of 80, which is higher than the average, which I believe is around 75. The regulatory index has been launched last year and will be updating and refreshing scores over the next period. And the last trend we examined today is related to the expansion of the mobile money value proposition that Ruan was mentioning earlier. So when we looked at our global adoption survey, we see that mobile money providers are reporting high year-on-year revenue growth and profitability. Revenue growth was around 24%, and we see that there's an increasing number of players that are reporting very healthy EBITDA margins. However, we also see that nearly 8 out of 10 providers report that most of their revenues are being driven by customer fees, and these providers are increasingly seeking to strengthen their value proposition to also meet the evolving needs of both individual and small businesses. And this has moved us towards a significant evolution of the mobile money business model, which we define as a kind of a payment as a platform approach that connects consumers with third-party services across a range of industries. And if we look at some of the innovative solutions on the slide, we can see the strong demand that there is for such innovative products. So for instance, in 2018, e-commerce transactions which were facilitated by mobile money grew 79% in value, and this has been driven by a large number of integration happening between operators and providers or through gateways. And we're also seeing, as I mentioned earlier, a number of operators looking to launch at their own marketplaces, such as Safaricom with Masoko. What we also see is that whilst there are just a few mobile money players that have developed a customized offering for business providers, these operators are very well placed to serve the needs of micro, small, medium enterprises thanks to their strong presence on the ground. And we conducted some research in some countries in sub-Saharan Africa, and we found that approximately 80% of MSMEs had a mobile money account, and they were using it specifically for mobile money, despite the kind of the service being tailored only for customers. Also, if we look at credit services, we see that 23% of providers that are offering credit services through partnership models or credit providers, and 41% are planning to launch one in 2019. And several of the deployments that launched digital credit offering in the last 18 months saw an average of 11% of the registered customer base take out digital credit loans. What we also see is that mobile money providers that are offering saving, credit, or insurance products have on average 24% higher ARPU than providers that do not offer these products. And the same providers are also likely to have a higher activity rate at around 46% than those who do not, which is at 27%. So closing, we see that as operators are launching new services, connecting to multiple business merchants and opening effectively to a platform model, they will be able to extract insights from new usage patterns and data and tap into new revenue sources. Therefore, it will be critical that commercial use of this data will be balanced with concerns around data privacy, data security, fraud prevention, and regulatory compliance and customer trust. And for any new product or services, providers should establish clear and open processes and rules for data security, consent, storage, and also anonymization and sharing. And improving access to credit for the underserved also raises a number of questions around responsible lending. So looking at how lenders can ensure that more widespread access to credit does not lead to an increased over-indebtedness. And also how can financial education by lenders, mobile money providers, and the wider ecosystem help address these concerns and these issues. So this is all from my side, but very keen to open the floor for questions and answers. And maybe Ruan, I think, will start answering a few questions.
Sure. Thank you, Francesco. I think one of the first questions that we got was actually through Twitter. And it's the question is, does the growth in smartphone usage enable payments as a platform approach? And what are the differences between Africa and Asia in terms of adoption? I think we've definitely seen a correlation that higher smartphone penetration is driving a wider range of products and services in the mobile payment space. Asia obviously has a much higher number of mobile money providers, and as Francesco shared, that are today offering mobile money applications via smartphones. And this definitely enables a much more enriched customer experience. So I think it definitely drives and lends itself more to the platform approach, or the payments as a platform approach, having a much more enriched customer experience that you're able to provide much more content and information to the consumer. However, I don't think this prohibits providers in markets that have lower smartphone penetration. I think that we've seen a shift in a number of markets, especially in Africa. And again, as Francesco mentioned, that in Africa we still see that more than 90% of transactions are driven through USSD. However, these providers are already making a shift to a payments as a platform model, more looking at the onboarding and ease of onboarding of small and medium enterprises and the billers through a much more automated and digital onboarding processes. And then we've also seen obviously an investment in the APIs and the platforms to make it more seamless to integrate. And a lot of providers are now publishing their APIs, making them available for third parties to start consuming those APIs to connect to the platforms much more seamlessly. So I think those are probably the areas that are already starting to help drive the shift to a payments as a platform across Africa, whereas Asia obviously has much more enabled through the smartphone and much more e-commerce and online payments behavior that's already established there. And I think it's an interesting dynamic as we see Africa's kind of shift to becoming more participative in the e-commerce and online space and driving this on it. And Asia, again, is kind of moving to trying to build these offline networks and agent distribution networks that are predominant in Africa. So there's kind of this emergence where these two markets are kind of going to collide and trying to copy what Africa and Asia, or the differences between Africa and Asia, to establish, obviously, for Asia, more rural networks that are having a further reach and reaching customers that are today excluded from financial services, where Africa is trying to untap or tap into this e-commerce and online marketplace and what we call the payments as a platform model. So I think on the active, or the next question on active accounts, 30 and 90 days, I'll let Francesco answer.
So the figure I mentioned earlier, which was around 300 million accounts, was referring to 90 days account. This is, we basically use this figure as this is more easily comparable to other financial providers or other kind of retail banks that measure activity in the same way. However, we also do look at active accounts on a 30-day base. I believe this is about 25% of the total registered accounts. So if you take 25% of that, 866 million. And throughout the report, we mention, it's clearly stated when we look at active 30-day or 90-day account. I think there was also then a question on the kind of looking at specifically at the use cases, if we saw if there were any regional differences in the kind of in use cases growth. I think we do see some diversification. So in sub-Saharan Africa, as I mentioned, bill payments and bulk disbursements were the leading ones that were pushing, that were kind of driving growth. In Asia, the picture was quite different. So bill payments was also present there, but in addition to that, there was merchant payments and international remittances. And when we look at merchant payments, I believe that the role of e-commerce and the kind of the number of integration there has been playing a kind of a key role. And we also then see a lot of use cases in terms of transportation, which can also be combined to merchant payments.
Sure. And then we have another question around to what extent making government payments digital affect adoption. I think, again, this is an important use case, and in a number of markets that we've seen this effectively deployed. It's really driving, again, the bulk disbursements and the ability for government to disperse subsidies to the communities and reaching rural communities. So we see that as a key enabler of mobile money and reaching people that are more rural and typically excluded from financial services today. And then at the same time is for the collection of a number of different government payments, including taxes. And we believe this is a key enabler also to drive higher collections. And we've seen a number of markets that are introducing e-government policies and really digitizing the whole government collection infrastructure in a number of markets, and really helping to increase the collections that government's doing, and obviously helping with their budgetary requirements, and at the same time helping consumers to start adopting the use of digital payments as a mechanism to pay for, like I said, taxes or business registration and all of these government type of payments. So we're definitely a key enabler. Another question we have here is around, is network interoperability the same as agent interoperability? I think this, gets raised at numerous forums and a lot of questions. In our view, when we talk about interoperability, we differentiate the use cases as person to person, or I think what the question here relates to is or network interoperability, where you're able to transfer funds between accounts, and this could be from one digital wallet to another, or between a bank account and a digital wallet. And this is typically interoperability we refer to. When we're talking about agent interoperability, again, I think there's differences in interpretation here, where we talk about exclusivity of agents and non-exclusivity of agents versus agents being interoperable. And I think when we talk about agent interoperability, probably the use case, or if you take it into a banking environment, where the banks would allow customers of another bank to be serviced in their banking hall, versus the ability to transfer funds between different bank accounts, right? So I think that the question around agent interoperability is probably less attractive to the industry today, and something that probably will not drive the competitive landscape, where a lot of the competition today and the investment is in going to reaching these rural communities and making that investment into building out agent networks. And at the same time, I think solving the liquidity issues, which is typically the factor that people raise in agent interoperability, is that it still doesn't remove the requirement on cash liquidity, which agent interoperability will not solve, in replacing the physical cash in that agent outlet. So I think for us, again, on interoperability, and I think as an industry we embrace interoperability of account to account and the free movement of value within the larger financial ecosystem, and believe that is the best way to increase adoption and make these services more affordable for users.
Then there was another question related to rural Africa, where issues like poor connectivity and lack of float for agents have impacted, or how are they impacting mobile money based on our assessment. So we see that these are, in fact, two of the main challenges in rural areas in Africa, but also in other regions. We see that, I think, throughout the years there has been an improvement in terms of kind of agent cash management by some operators, but connectivity issues and also I would say, economics of agents in rural areas remain challenging, but they have been an increasing, I would say, priority for operators, which are continuously rolling out these networks in these areas as permitted by the kind of economic and profitability of it. Ruan, do you want to add anything on that?
No.
Okay.
No comment. Sorry, let me just see what other questions you have here.
There was a question asking if we were able to see which mobile money services men and women use. Not at this level of granularity for which we ask data for. Generally, we see that though a number of operators that are launching specific products targeted at women. We do, however, have a connected women team as part of the Mobile for Development team of the GSMA, and they will probably be able to provide more information on this, so we are happy to do a follow-up in connecting this.
There's another question here. Could you suggest launching mobile money in Vietnam while there is no regulatory framework for mobile money there? And I think that's quite an interesting question, because in a number of the markets, especially in East Africa, if you look at the evolution of mobile money in specifically like Kenya and Tanzania, there was very little regulatory framework in the initial launch stages of those services. And a lot of the regulation followed, a number of years after these services launched. There were very, I'd say, loose regulatory frameworks put in place that basically just guided on ensure that the funds are kept safeguarded, or consumer funds are safeguarded within commercial banks. And typically the models that are followed within East Africa is where there's a trust fund where whatever e-value or e-money that is issued is held within commercial banks. So effectively, consumer funds are safeguarded in the fact that these funds are held within the formal financial ecosystem. But at the same time, having the ability for mobile operators to go out and issue wallets and within a risk-based approach, again, on what type of KYC is required, and having low or wallet limits set in such a way that it doesn't increase risk of, for example, AML or CFT types of incidents. So I think a number of these markets took a very open approach and a more relaxed regulatory approach, and allowed the industry to evolve, and then created regulation around the industry as and when it was needed. So I think in Tanzania, for example, the formal regulation was only published in 2016, where the services launched in 2008. So for 8 years, these services operated within regulatory frameworks and updates from the central bank that would send out effectively a prakas, as they call it, to the industry to kind of indicate how these services should be run. And this was updated on, could be monthly or quarterly basis as there were changes in the industry required, or wallet limits had to be changed or reduced, or in some instances they increased limits based on KYC. So I think that the approach in a number of these markets allowed the industry to evolve much faster and obviously learn as they went along. So I would definitely encourage that type of approach to enable the adoption of mobile financial services or mobile money in greenfield or markets that are just starting out.
A question related to SMEs. Asking basically, in Africa, SMEs are wary of the kind of the taxman, as they don't want to kind of attract taxman's attention. How do we address this concern? This is true. We did extensive research on SMEs recently. We saw that cash, it remains king, but mobile money has some very strong benefits, which are perceived by SMEs. And in fact, we saw, as I mentioned earlier, we saw that 80% of SMEs that we interviewed in several countries were already using mobile money. And what research highlighted was that these SMEs were both sending and receiving payments multiple times a day. And this highlights the kind of the use cases for these businesses. As in comparison, on a personal base, an average customer will be doing 7 to kind of 10 transactions per month, if we exclude airtime top-ups. So I think that should be the starting point for which mobile money kind of providers will be looking to provide services. And then on top of that, they can also provide services to kind of simplify and facilitate the kind of the tax kind of tax declaration and tax payment paying providers.
So we're just seeing what other questions we have here.
There are a couple of questions, I think, which are interesting, but unfortunately, I don't believe we will have sufficient data, or we don't have, the GSMA doesn't cover in terms of data. One was related to a potential increasing gender gap in Ethiopia. Unfortunately, we haven't looked at this in terms of data. So unfortunately, unable to answer this question at the moment.
I think what's interesting, maybe on one of the questions, were you able to see which mobile money services men and women use? I think this is definitely an area of focus for the GSMA, and as Francesco mentioned, we have the Connected Women team that is specifically focused on the gender gap across a number of different mobile sectors. So, and we're also looking at that from the mobile money space. And we're introducing the tool that I mentioned earlier in the forward on the gender analysis tool that we have developed last year, which will allow us to look at not just mobile data, but actual mobile money data, and identify trends and patterns and the different usage patterns of men and women across not just the mobile space, but actually mobile money space. And we believe that this could provide a lot more insights to providers on the types of services and products that we should be introducing in future that could also assist in closing the gender gap and the adoption of usage for women and men. I think in a number of the markets that we have looked at in more of surveys and discussions with operators, we tend to see that women are much more active as agents and are economically active in a lot of these rural markets, especially in Africa, and are probably the key enablers of the agent networks and mobile money in those rural communities. So there's definitely a correlation between the adoption of mobile money and female agents in a lot of the markets that we've visited. But definitely more work needs to be done on getting insights and information about this. So I think we're going to end the webinar there. We run out of time. We appreciate everyone for joining us, and we look forward to engaging with you in future. And please do feel free to ask us any questions. As we have it on the website there, you can also send through your questions to the team, and we'll try and answer as many of the questions as possible going forward. Thank you for your time, and have a lovely day.